Hi, today we're gonna talk about adjustments to aggregate demand, aggregate supply, and stagflation. In this diagram, on x-axis we have GDP, on y-axis we have price level. So at long-term, aggregate supply curve intersects aggregate demand curve, initial aggregate demand curve at P0 price and GDP star. So this is our equilibrium price and for full potential GDP output or at full employment level GDP output. So our aggregate demand could increase by change in consumption, investment, government spending. So in this diagram, it moves from AD0 to right hand side to AD1. At this level, our price increases from P0 to PSR, whereas GDP operates at higher than its full employment level, which is GDP1. So at this level, due to increase in price would reduce the real wages, and that would cause increase in wages would cause short-term supply to increase. So you can see that uh, uh, short-term supply increases on the left-hand side, and the new short-term supply curve became SA S1. And at this level, you can see our GDP fell back to its full employment level GDP, whereas the new long-term price has increased to PLR, where the AD1 intersects the long-term supply curve. However, stagflation is a little different phenomena. It's an environment where the both high unemployment and high inflation, it caused by shift in supply curve. So in this example, uh, it's a similar to what we just saw. This is a long-term supply curve, and earlier AD0 is a aggregate demand. Our initial price is P0, initial output is GDP star, and there's a short-term supply shock which moves the curve from SA0 to SA1. So at this shock level, you can see the prices have increased, and the GDP has fallen from the new employment from few full employment level, and is fell to GDP1 when where there is a underemployment. So this is and if economy as is at this stage for a longer period of time, it's called stagflation, because the prices have increased, and there is no full employment yet. So in this situation, government can intervene, and it can cause government can start spending more, can start building the infrastructure projects. So in those cases, you can see the AD0 can increase to AD1, and when it increases, our price level do further increase, which is PLR, but it moves the GDP to at its full employment level. So at this stagflation scenario, you can see the investor, excuse me, would decrease the investment in fixed income security, because the inflation put upward pressure on interest rate. So as we know, as interest rate rises, our fixed income security prices fall, so fixed income won't be a good investment. Since there is inflation, so there could be sell-off in equity market, so investor wants to decrease exposure to equities, and in this kind of situation, investing in commodities, especially like inflation hedge commodities like gold, would be a safe investment from investors perspective. Thank you.